Sandeep. Hi, Vaibhav. It's a pleasure to have
Hi, hi.
you in a conversation with me today. So delighted you could take our time for doing this with us. To introduce you, Sandeep, you've been a veteran private market investor. You've essentially seen how private markets have changed in India. Not only the way startups work, the way startups raise capital, but also how the face of venture capital and private equity is really transformed. And then you'll end up forming a firm called Oyster Global. So tell us a little bit about Oyster. What does Oyster do? What are you trying to achieve?
Thank you so much for having us here this evening, and thanks, Weber, for you to join in as well. We are at Oyster Global. We are an institutional investor. We invest in top-tier private market funds, whether it's a venture capital, whether it's a private equity, whether it's a venture debt. And I think the whole strength behind the organization is the deep diligence that we run behind each of the funds, the amount of the depth at which we evaluate the landscape, and actually end up picking the funds which have consistency of track record, good track record of actually delivering liquidity, because I think that's a very important metric. And overall, folks who are the GPs who have actually been there and done that, right? I mean, they understand the landscape fairly well. Most of the time, such GPs are, not available. It's the access to these funds are usually not there. So in some sense, I think we have breached that boundary and gone ahead and kind of developed deep relationships to be able to invest in funds with incredible and consistent track record.
Thank you so much, Sandeep. Sounds exciting, and we'd obviously explore a little more about your take on how diligence happens and what do you see in fund managers. But quickly moving to Vaibhav. So Vaibhav, you've really taught people how to invest and how to make money on their money over the last 2 decades. You've managed more than 22,000 crores of AUM. And if that achievement was not enough, you then started Deserve, which is a platform all of us are very well aware of. So let us know a little bit about Deserve.
No, absolutely. Pleasure to be here, Malika and Sandeep. Thanks for inviting me. The idea behind Deserve was to create a house of investment solutions which can serve the needs of emerging HNIs and also affluent Indians. So our focus has always been to provide investment solutions which meets the specific needs of these individuals. We've seen over time that individuals have specific needs across asset classes, and unlike Oyster, which is focusing more on institutional investing, we focus much more on individual investing. And these individuals over time have created significant amount of wealth, which they want to invest across different asset classes. And that's where we have built our capabilities. We run a very robust investment process where we use data science, we use significant intelligence to understand which portfolios are fit for which market environment, and invest our money for our investors across these asset classes. We started our operations about a couple of years back and are managing more than 5,500 crores of assets for more than 5,000 investors. We are present across four different locations, and really excited about the journey which is ahead of us.
Absolutely. We're looking forward to that journey ourselves, Weber. I think your introductions really paved the way for this conversation to start, because the way you introduced Deserve and the way you introduced Oyster Global really, in a way, shows us how India is transforming and the way Indians think and Indians operate is transforming, right? I still remember vividly in 2014, and I was just out of school at that point in time. I read an article that said India is in the fragile five. And it hurts as an Indian to read something like that. And now you pick up any newspaper, India is literally the golden spot on the world map. And I think a lot of that has been possible because of the way the entrepreneurial spirit has actually budded in India, right? Every new innovation, every new invention, the adoption of UPI, the way space tech becomes popular, the prime minister we have, the way our startups are actually raising capital, the kind of investments that our VCs and our private equities are making, and platforms like Deserve that really come to the forefront to really teach people how to make money, right? I think all of this just shows how we've transformed as an economy, as a population. And I think with that change, we also want to really dive deep into understanding a change that is happening in a particular asset class, which is fund of funds, a lesser known name, but a well known name. A name that people actually want to understand and deep dive into. They want to understand what a fund of fund really is, but there's also a lot of misconception about what a fund of fund really is. So why don't we actually start today's chat with first starting with an anecdote? I'm sure since both of you operate in this space and you have fund of funds of your own, you must have encountered something which was funny, which was unbelievable. Why don't we start with you, Vaibhav? Tell us an anecdote, about a misconception that you've heard about fund of funds, and please use that to define, in your words, what a fund of fund structure really is.
No, thanks. Interesting. So recently, I was having this conversation with a fund manager who runs a very large private credit fund, and we were having chat. And his perception of fund of fund structure was limited to the cost which is levied by the fund of fund on top of the fund. He didn't understand the value of fund as a structure, and he saw it purely from the perspective of additional layer of cost. And I think there was a little bit of misconception there. In our view, fund of fund is a superstructure which allows us to create an investment solution for our investors where they can access cumulative intelligence which is available in the market. There's so much intelligence which is available in the market, and fund of fund, in that sense, allows us to capture that intelligence and give it to our investors in a much more cost-efficient manner. And we'll touch upon that point of cost efficiency in a little bit.
Absolutely.
But to summarize, the reason for which fund of funds have evolved, and given my experience of managing wealth for clients over a long period of time, I've seen clients requiring diversification in all asset classes, be it listed equity, be it fixed income. And that's the first principle we learn when we think of investing. So fund of fund, in some sense, is achieving that objective without having to go through a lot of cognitive overload for the clients. There are expert investors or expert fund of funds which are available, which are doing that hard work for the investors, where they are selecting multiple funds, packaging them through a fund of fund structure. So investors, when they invest in that structure, gets the diversification benefit, gets the institutional diligence framework, and are able to access an asset class which may not be accessible otherwise, because many of these funds, underlying funds in which fund of funds invest, don't take money from individual investors. So we are able to provide that institutional quality fund access by using fund of fund as a vehicle. So that's my interpretation of fund of fund and its utility.
Well, thank you so much. In fact, I love a phrase that you used, which was superstructure, right?
Yeah.
And I know Sandeep calls his superstructure a blend. So, Sandeep, why do you call it a blend? Why don't you call it a fund of fund? And what's the superpower of your superstructure?
So, I think, Malika, the interesting thing about this whole concept of fund is that everybody has their own interpretation of it. The more the number of people that you go and ask, they have different philosophies. But one of the other things that Vaibhav talked about was the whole avoiding the cognitive overload and diversification. I think those remain the core building blocks of what this product is all about. But in our world of Oyster Global, we actually don't even use the term fund of fund, because our belief is so many times people end up coming with preconceived notions and preconceived thoughts. We call it more like a multi-manager product. We call it more like a blend. And in my mind, there are at least two or three core differentiators. The first core differentiator is that in our mind, this blend is a transparent structure where an investor precisely knows where his or her capital is going to go. Typically, in a conventional manner, fund of funds is something where a manager is saying, you give me the money, trust me with where I'm going to deploy, and I'll pick the funds over a period of next 2 years, 3 years, 4 years, and so on and on. We have changed that dimension, and we are saying you would precisely know which funds we're going to invest in, whether there are 3 or 4 or 5, and that's why we call it blend. Not only that, we will also define the percentage into which your capital is going to get distributed across those different assets. So, for example, if you are somebody who wants to say that, okay, this much is going to go into this particular venture capital fund, this much is going to go into this growth fund, and this much percentage is going to go in your private equity fund. So you, as an incoming investor, would precisely know and be transparent to where this is going. The other is the whole commercial layer, where we basically say that no matter how we assemble the products, no matter which world-class fund we bring to the table, we are not taking your cost structure beyond 220. In some sense, we're going to eliminate this whole concern around fee. And that's very interesting because, in India, most of the investors are very, very fee savvy, right? Surprisingly enough, not too many people spend as much time understanding the returns. A lot of people spend more time understanding the fee and the cost structure. So using Vaibhav's word, we're going to remove the cognitive overload required to understand the fee structure. We are saying no complexity, it is 220 no matter what. And even if they go to the fund directly, they would still be the same. Those dimensions basically qualify for us what we call the multi-manager blend or a multi-manager product.
Got it. No, I think very interesting. And, that also then jogs another question in my mind, Sandeep, and I'd like to ask you this question. We obviously know that private markets are growing in India. There's no doubt about it. In fact, statistically, I read somewhere it said that when India does become a 5 trillion economy, about 10% of that contribution is going to come from private markets, right? Now, just tell me, Sandeep, do you think that this growing private market trend is what catalyzed the need for a fund of fund structure, or was it always the need? We just ignored it for the longest time as an Indian economy.
So I think there are, I would say there are two aspects to that question. I think the first is about the private market itself, the understanding of the private market. I think candidly, it's a difficult market for a lot of people to understand because the information availability is really, really scarce. Not that anybody is trying to hide it, but it's just not readily available. So, in fact, we conducted one exercise with Crystal where we basically mapped out the public market versus a private market equation. Even we were shocked to see that the delta over a 10-year period is about a 13.5% IRR. That's a massive number, right?
Absolutely.
Most people don't understand that that is the delta or an alpha that you can create by entering the private market. Now, once you know that, the second aspect is that the entry barriers are high, because of which the capital required to enter a top tier fund is really, really high. If you want to pick a top performing private equity fund in the market, the ticket size could be as large as 25 crores, right? Now, if somebody has the wealth where they're going to put in 25 crore in a single scheme of a single fund, you're talking about family offices which are at least about 1,000 crores and above. Now, that truly restricts the access to this high returns asset class to very, very few family offices or individuals or ultra HNIs in the country, right? Now, this blended structure or the multi-manager product makes that challenge go away. Even if you want to kind of put a smaller ticket size, what we at Oyster Global do is we would unitize the whole amount down to 1 crore. So normally it would take you 50 crores.
Absolutely, no, fair. Vaibhav, what according to you is the biggest entry barrier that a fund of fund structure breaks?
Two things to add to what Sandeep said. Many people have expressed interest in this asset class. And one of the primary reasons for that is the return differential. The return differential is very large. Globally, if you look at the size of the private markets, both private equity as well as private debt is as large, if not larger than the listed equity market participants access, listed market that the participants can access. Now, the big challenge there has been how do you access that market? Before 2023, I've seen three dominant players in private credit. First, you had wholesale NBFCs, which were active participants in private credit market. Second, you had mutual funds, which were through credit risk funds were participating in this space. And you had banks. And all three participants have cut down their exposure meaningfully. Mutual funds for obvious reasons, because there is no flow in the scheme, so therefore there is no allocation which is happening to private credit. Wholesale NBFCs, for the right reasons, have moved away from wholesale lending and are focusing much more on retail lending. So that pool of capital has disappeared. Now that has opened up a big opportunity for individual investors, but
Yeah.
the barrier has been minimum investment amount. The vehicle that you use requires you to commit a certain minimum amount. If you
Yeah.
want to invest in a single fund, you would have to commit 1 crore. If you want to invest in multiple funds, that means you'll have to commit 4 to 5 crores. And if you want diligence layer, then you'll have to go through a fund of fund structure.
Got
So
it.
what fund of fund structure has been able to solve is to give you exposure to multiple funds with an investment of 1 crore. As Sandeep said, by unitizing this, you are able to create and solve that access problem for investors. So which has been a big victory for the investors. Second, I think from the investor's perspective, because there is a relatively new asset class, they require much more handholding. And
Yeah.
that handholding in the entire process comes easily through the fund of fund structure. So these are the two additional points that I would like to add.
Absolutely, very fair. And I think it's important, in when it's at the inception of its journey, an asset class like this definitely needs handholding from institutions like Oyster Global and Deserve to be able to help people understand what's truly the. But interesting, you broached the topic of private credit, Weber, because my question to you was going to be: we know private credit is now, it's here, right? But what, according to you, is the potential of this particular asset class in India in the future?
So there is a significant potential. As I said, there were three participants, and all of these three have cut down their activity levels, and which opens up this opportunity. India is a growing economy. Need for capital is there, both equity capital as well as debt capital is there. And now, given that these pools of capitals are available, they can reach out to many more borrowers and extend the credit. The good part about the private credit through organized structure is the security mechanism is very tight. So I
Hmm.
see many investors, and one of the anecdotes that I would like to share is from a client. He used to lend money to his friends and relatives, and obviously he felt very comfortable doing that. But
Yeah.
eventually, when his relative or a friend went through tough time, he could not recover that money,
Yeah.
and that creates a lot of issues, both emotional as well as financial. And in case of private credit fund, all of these issues are resolved because most of these funds are managed by professional fund managers. This put in place a strong security and ensure that in case of stress, they are able to realize that security. So
Yeah.
some of these points are extremely relevant when you want to lend money through private credit structure. And I believe that the size of this market and India today, if I am right on my numbers, 2 lakh crores of total banking and lending market is there, out of which 70 to 80% today is serviced by banks and NBFCs. Over time, I see private credit becoming a meaningful part of this pool, and 20 to 30% of this market over time will get serviced through private credit, which currently is happening, but in an unorganized manner, where private lendings are done by way of intercorporate deposits or friend lending money to a friend. So those kind of structure, all of that will get replaced by private credit funds.
Value or creative nature of this particular asset class. So we're in line for a tectonic shift in the private credit place.
Absolutely. And the other thing is the return differential. So risk-free rate of return has gone down, and which is something we've seen playing out in developed markets also.
Yeah.
The reason for which private credit funds became popular is the return differential, which was there for them. If your risk-free rate of return is not covering your inflation also, then you need to look for alternative sources of
Creative
income.
solutions.
And these funds play that role perfectly.
Absolutely. No, thank you so much for that insight on private credits. I'm now going to shift back to you, Sandeep. And I think when you started introducing the blend structure and, why did you come up with that evolutionized form of private credit? Fund of funds, you mentioned transparency. You said transparency was an important criteria that you thought was the driving force. So tell us about why transparency in this asset class is so important.
So I think a few core factors. Private markets, by the whole design, is a little bit more complex. You use terms like DVPI, TPI, and so on and on. Half the people kind of get confused and lost just between that.
Yeah.
All transactions are private, so it's almost impossible to know at what value somebody entered, what value somebody did. The big, huge elephant in the room always is that this is a return on paper. This is not a real return. So you got to actually look at liquidity, not just that this is a paper-based IRR.
Yeah.
Right? So when we started diligencing funds, we realized that there were just so many various factors which were behind it that it was genuinely complicated. Most people know a fund by the 2 or 3 successes that they have delivered as an investee company, right? They would know, oh, that guy created 2 unicorns, or that guy did this particular transaction, which is super. Whereas the institutional way of diligencing is actually about looking for consistency. This common belief that 2 successes and 20 duds makes a great fund is unfortunately neither true nor realistic. So we would any day invest in a fund which has perhaps a lower IRR, but more consistent track record. I mean, if they have like maybe 10 out of 15 companies which are performing good, but their whether their DPI is lower or whether their IRR is lower, we would rather go with that versus a fund which would be like a 2-company wonder or a 3-company wonder. And most people who are in the world of private markets understand it. It's usually, some of the folks who are being exposed for it for the first time have a challenge. And then you can't really go and find these metrics anywhere, right? Till recently, even the quartile performance bars by Cat 1 and Cat 2 and so on. If you merge, a private equity fund like Multiples or a Chris Cap along with an, early stage deep tech fund like Special, I mean, there's no way to be able to look at the comparison between their return profiles, right?
Yeah.
So the first time, not only we are doing it for ourselves, but we are also working with Crystal to actually publish the quartile performance by the stage of the fund. So you take things like vintage year, right? I mean, there are so many definitions floating with vintage year, whether it was the year when you launched it, whether it was when you did your first close, whether it was when you did your final close, and so on. And so I think the whole effort is primarily even behind just the whole education piece for all of us to be on the same page.
Absolutely.
And we build a blend. We basically look at each of the comprising fund from that lens.
Yeah.
And the intent is, going back to the point again that Vaibhav was saying, you don't want an incoming investor to have the same cognitive overload to go through 5 different funds, understand all the documentation behind it. And over a period of time, we would like Oyster Global to be understood as a name that they can trust, right? Somebody who has done the groundwork required. And that's why we have, our chief investment officer is David Wilton, who comes with a 30-year plus of track record of being a CIO of IFC and so on and on.
Yeah.
So the team composition, the actual fund selection, all of those take into account ensuring that if there is not enough transparency, how do we go above and beyond to be able to do justice to an incoming investor?
No, fair. I think, Sandeep, on that, I would also like to ask, I think somewhere you mentioned at the start of our conversation that private markets deliver a 13.5% alpha over public market returns. Is it true for all funds in the private market space?
So if you look compared to a listed world where the performance of a top quartile fund and a bottom quartile fund is not too far apart. In most cases, you're talking about 5 to 7% delta. But if you look at a matured market, even like a US, a top quartile fund would be performing, let's say, close to about a 25% net dollar IRR. But by the time you reach even quartile 3, you are beginning to lose money. So the performance gap in a private market between a top performing GP and somebody who is not delivering the same performance is massive, which is why I think the act of actually picking up the right manager, doing the due amount of diligence behind it, and ensuring that your investments are typically lying between the quartile 1 and quartile 2 becomes an absolute mandatory aspect.
Absolutely. I think that links to Weber what you were saying that it's important to identify who basically form constituents of a structure that you're creating, and that is obviously heavily dependent on the ability of the fund manager, the fund house, right? With that, Weber, I'm itching to ask this question. Do you think that a fund of fund structure is the way for an investor to now tap into the growing Indian economy, the growing Indian private market ecosystem? Or do you think there are more efficient structures out there?
No, I think fund of fund is the best structure to tap that market. Uh, because as Sandeep mentioned, data availability is extremely sketchy. So you need someone to actually go through the data and understand which fund has delivered what kind of returns, whether the returns have been realized or not, whether the returns have been distributed back to the investors or not. So these are some of the important considerations. And obviously, because information is scantily available, you require someone to commit a really large pool of capital for the investment manager to allow you to go through that data.
Hmm.
It's very difficult for an individual investor to interpret the data. There are so many complex terminologies. DVPI is what Sandeep spoke about, money multiple, MOIC. All of these are important and relevant terms.
Yeah.
So as a fund of fund, you have this special ability to commit large capital to these funds and therefore buy the right to do diligence, which is much deeper than what an individual investor will be able to do. And second point, private markets are generally much more inefficient compared to public market.
Yeah.
Public market efficiency is very high, and that's why the return difference between a top quartile fund and a bottom quartile fund will not be very large because scale of inefficiency is so limited that even the best fund manager will have very limited inefficiency to capture. So
Hmm.
in that sense, in private market, when inefficiency is very large, the difference in return which will be generated by a good fund manager and a bad fund manager will be very large.
Would be
And
large.
that's why you need someone to actually sit down and create a portfolio which will be there in top quartile.
Top
And
quarter.
that's where your return differential will be very large.
So
It's
if
a complex,
sorry, please.
sorry, it's a complex market and you need significant diligence and research before you can construct a
Before you
portfolio.
do. Absolutely. So if
Also,
I'm
Malika,
understanding this, sorry, Sandeep, go on.
so I was saying the other dimension is also the access part, right?
Yeah.
So I was saying earlier that even if you are a high-end HNI,
Yeah.
how many funds are you going to put 5 crore individual checks in, right? I mean, the good ones. Now, you take a look at this whole unitization part where we're talking about the blend portfolio. Not only you have it at 1 crore, the crore is spread over 3 years.
Hmm.
Then, with the power of accreditation, you can actually take down that crore to about 25 lakhs. And then
Hmm.
again, this 25 lakh is spread over 3 years. Now, think about it, the ability to invest almost about 8 lakh rupees per annum for an asset class which has a established track record of, at least there are about 40 fund managers in India who are on third fund plus. So the moment you bring it down to the point saying 8 lakh rupees somebody has to invest in a year, that opens up the horizon so dramatically. The opportunity becomes so humongous, and we all know the pyramid of India. You want to go down from 500 crore to 100 crore to a guy who can invest in about 8 lakh rupees or 9 lakh rupees a year. That dramatically alters the whole equation. The affordability
Absolutely.
becomes very, very different. The access becomes very, very different. The reach and availability of this asset class. The actual aspiration and dream is just like the way the listed market today is powered by the capital which comes from domestic pool. Our entrepreneurial capital, which is the source of innovation, which is the source of disruption, has to be powered by domestic capital. There
Yeah.
is no reason in the world why our own domestic capital should not be powering this asset class, which is where I think all the different things begin to align: the regulatory piece, the government push, the desire of an entrepreneur to raise domestic capital, the GP's preference, the incoming investor's preference, all the different dots suddenly begin to align the moment you move in that direction.
Absolutely. And I think it actually becomes possible because of institutions like yourselves. Because when you take the burden of doing institutional level diligence, then it only makes sense that the benefit of private markets should be able to go down to the absolute bottommost of the, investment economy of India. So I think very fair. So let me just dissect this and make it easily understandable. So you as institutions basically invest institutional capital in fund managers. So you take the burden of actually writing the bigger quantum checks that not only give you the visibility into the financials, the strategies, and so on and so forth, but you then further break that investment down into unitized 1 crore pieces for investors into your funds. Is that correct? Is that the best way to understand a fund of fund?
Absolutely.
That would be fair. Though I don't want to miss one other major dimension that, while we've been talking about the power of unitization, taking it to the smallest amount of the investment size, the fact is that, again, if we look at ourselves, we have diligence about 200 plus funds. A lot of fund managers have given their trust to us and kind of shared the amount of information that they would not typically share.
Yeah.
So for a moment, I want to switch to the other side of the equation, saying not just about individual investors, a lot of family offices who do have the capability to write a 10 crore check or a 20 crore check, even they find it challenging to be able to diligence at the level that we diligence.
Right.
So while from a unitization standpoint and from a ticket size standpoint, it is a lot of value for a lot of individual investors.
Yeah.
But when you come to the power of diligence, looking at the whole landscape, going deep, running a 60-page worth of an investment note on a per fund basis, not a whole lot of family offices or small institutions actually have invested or have the whereabouts to be able to pull that off.
Absolutely.
So, while on one side of the spectrum, this value proposition is relevant to an individual investor because of the ticket size, similarly, on the other side of the equation, for the bulk of the family offices and small institutions, the power of diligence makes it relevant for them to consider the same product. So actually, the span of the incoming investor is actually quite significant.
Very well put, Sandeep. I think it makes a clear case of why a fund of fund structure is equally relevant, irrespective of the investor is a small investor or a large investor.
The other cherry on the top is
Yeah.
some of these funds would never take money from individual investors.
Absolutely.
Only going to take money from institutional investors, and that access opens.
Absolutely. So I think then another question that I'd like to pose, and maybe Sandeep, you can take that for me. Obviously, I think the one term that screams when you say fund of fund is diversification, right? You're diversifying your capital across 3, 4, 5 fund managers. But does it not also sometimes mean over diversification? Because, as when you start dissecting, one fund will maybe have 10, 20, 30 portfolio companies. So if I'm putting together 3 to 5 funds, I'm opening up my exposure to maybe 50, 60, 70, 80 portfolio companies. So do you think over diversification is something that an investor should worry about?
Actually, I discovered that at the very start of my own personal investment journey with mutual funds. For my own satisfaction, I bought like 5 or 6 large cap mutual funds and the mid caps and so on and on. And when you are just starting to invest, you don't really have a clue that, ghoom phir ke at the base, you have the same set of companies across the board.
Absolutely.
So that false belief that I had in my mind, literally at the start of my investment journey, that I don't care why, but I just want 5 mutual funds, wasn't really giving me as much of a value. Now, in the case of private market, where a lot of the funds are very heavily thesis driven, there are multiple dimensions across which you get diversification.
Yeah.
So let's start from the very basic one, right? Let's say the vintage diversification. So if you invest about funds which are spread over, let's say 3 years or 4 years or whatever around, the price and the entry point and so on and on vary dramatically because of access of capital, not capital, whatever else, the price points being different and so on and on. So that's one aspect. The second is the stage of the fund, right? When you go into an early stage fund to a VC, to a growth, to a private equity, you are doing a return and risk profile, which is fundamentally very, very different across the board. Then is the whole sectoral part, right? When you go for a deep tech fund, you precisely know that a deep tech fund is not going to be having an overlap with, let's say, an environment fund. There's a healthcare fund. There's a
Okay, fine. Go ahead then.
so so in concept of the private markets, there are so many different dimensions across which you can run the diversification that it creates a distinctive factor where you can invest in multiple assets without actually compromising your returns.
I think compromising returns is going to be something, Sandeep, that people are very conscious of, right? Because you usually feel if you're bundling too many things together, it's value dilutive in nature. It's not value accretive. Vaibhav, what's your view on it? How do you see over diversification? Do you see it as a concern at all?
So we have to see it in the context of the category. So when you look at private credit, when you talk about return dilution, in private credit, returns are well defined. Okay, so predefined. You know whether you'll get 14%, 15%, 16%, or 17%. Over diversification is not going to dilute your returns. So it's never going to be return diluted because returns are predefined. Risk will keep getting diluted as you keep adding more instruments. Since returns are predefined, the only variable that you are controlling is risk. When it comes to private equity, as Sandeep mentioned, so we consider three parameters. First, geographical diversification, extremely important. How do you diversify your exposure across geographies? So US has been an hub for the innovation. So why can't we have exposure to the US markets also? Similarly, you can have category level diversification. You can have stage diversification. So early stage, mid stage, late stage. So diversification should lead to return accretion, not return dilution. By making diversification more scientific across categories, you are ensuring that you are just reducing risk. You're not adding risk and you're not reducing returns. So it's important that diversification results into reduction of risk, not reduction of return. As Sandeep said at the outset, when he invested in 5 different mutual funds, if everyone is holding the same securities, then there is no diversification. But if you are able to generate returns from different sources, then you are adding to returns and reducing the risk. And that's how I see diversification.
Absolutely. No, I think very well put there, Vaibhav. That brings me back to another question on risk management. Sandeep, and I'd like to start with you. As a fund of fund, I believe you cannot obviously control the portfolio, right? The portfolio of companies that are invested in. So what, according to you, as a fund manager, is risk management in a structure like a fund of fund?
I think we start with a single unit. I mean, the single unit being a fund, and then we diligence that particular fund from the objective saying that what has been the track record of that GP. In most cases, we have typically gone for the GPs who have at least done 3 or more funds. So that makes a world of a difference. There is a tangible track record to go after. In case we have picked any of the GPs who are in the earlier phases of the funds, then these are the GPs who have done enough of investments in their past career track record where you can create a literally 1:1 causality that this was a specific GP who did this kind of work.
Yeah.
We actually go and talk to the entrepreneurs, right, to understand not only the quantitative side of the equation, but also how's the relationship, right? How do the whole concept of the value add that the private market funds keep talking about, how does that translate? So once you do all of that stuff, then you at least at a unit level know that this particular fund is going to perform well.
Yeah.
Then we look at the whole thesis to say from a sectoral standpoint, what is the total opportunity size? What is the market looking like? I mean, is there an opportunity where literally 3 or 4 funds can actually survive? Malika, you were talking about the whole the consumption side or the consumer side of the economy, right? I mean, we're talking about a number hitting to $5 trillion and so on and on. So that particular segment is large enough for us to be able to do this.
Sure. If I was to take this question with you, Vaibhav, obviously, private credit as a structure would, I believe, require a lot of post-investment monitoring also, which is risk management, in nature. Would you like to touch upon a bit of that?
No, so there are three things that we consider, Malika. So first, obviously, whether the fund manager has been able to exhibit uh, ability to come out of a distressed situation, and which is a true mark of fund manager's ability to manage risk. So we evaluate all the transactions that the fund managers have executed in the past, whether there was any distress situation or not, and how did that fund manager handle that distress situation. So that is very, very important. So from our perspective, the first thing that we evaluate is whether the fund manager has gone through multiple cycles or not. If you know how to come out of a bad cycle, then you'll do really well in the fund. Second, what kind of companies and securities that fund managers are selecting? Extremely important point, because if the underlying security is not protected through a cash flow in a country like India, enforcing a security should be the last resort. So in terms of diligence framework, the repayment of the loan should have been baked in from the cash flow which the business was going to generate. So extremely important parameter again. A lot of people do transactions which involves refinancing. We don't like to work with the fund managers who would focus on refinancing of the transactions. Third thing, again, very important, is repetition of the transaction. We don't like to work with the fund managers who are simply repeating the transactions in which they invested from their previous fund. That means you are trying to refinance your own loan. So which is a big red flag for us. So these are some of the parameters which are important for us. But honestly, we don't work with the fund managers who have not done underwriting in the past. That's an extremely important consideration for us. We like to work with the fund managers who understand how to secure the transaction, what are the parameters to consider, whether the cash flow is adequate enough to repay the loan or not. So these are some of the considerations which are there. Obviously, there are many other parameters, but these are primary parameters that we consider.
Thanks for sharing that, Vaibhav. I think I'm going to now pose the last two questions to the two gentlemen. So obviously, Vaibhav, you started with an anecdote on fee, and we all know no matter how rich we get, we're always going to be a very cost-conscious economy, right? So since we already understand what your view as deserve is on fee in a fund of fund structure, Sandeep, why don't you share your view? How do you see fee in a fund of fund structure?
So first of all, I think India is a value conscious market, not cost conscious market. We don't spending a crore on Mercedes. So as long as we believe that we are deriving value out of it, we don't mind spending. But having said that, I think fund of fund structure, fundamentally, given that you have option to invest in funds under direct plan now, the cost structure has come down. And given that you can commit large ticket sizes, you get the benefit of higher slab also, where your fee automatically goes down. So for the investors who are investing in a fund of fund structure, they are not getting penalized at two levels. Sandeep mentioned at the outset that with 220 structure, you can still make a commercial sense of investing in a fund of fund structure. And the reason for which we are able to do it is because the fund fee, when you're committing large checks, go down.
Got it.
That's
So
an
I'm
important
believing
point.
it's the same principle for you in terms of an equity fund of fund?
Very, very consistent, actually, very, very consistent with what Vaibhav said. And I think um, my personal belief is that the more people get acquainted with this asset class and they start to realize that there is a spectrum of funds where some funds are truly differentiated. I think at some point in time, people would be willing to move to 2.5%, maybe slightly higher carry, and so on and on. But I think we should also understand that we are, even though the fund business has been there a lot, non-institutional investors have not been very actively investing in this space. So it's a start of the journey. At the start of the journey, I think we need to make the thinking process very, very simple. The more complexity that we create, the challenging it will become. So if you keep things as simple as what Baba was talking about, right? Keep it 220, tell them there are no multiple layers. You're not going to pay anything extra. Your return profile is not going to get diluted. There are no tricks in the game. The metrics and everything is very transparent and clearly laid out. The diligence process is explained in a very, very simple manner. I think the beauty of the private markets is going to be in the simplicity with which we can present it and not make it complex for intellectual reasons. And I think that would be the winning thing to involve as many people as possible in the whole process.
Absolutely. I think demystifying the asset class and the products within this asset class is, I think, very critical at this stage in India. I think with that, I come to my last question for the both of you. Obviously, this is a highly regulated business, and I believe both your structures are category to AIFs. So just give us a sense, and obviously you've dealt with a lot of regulations coming thus far. What do you think is the view you have on the regulatory system in India around private market investments? Do you think they're enabling this market growing further? Weber, why don't we start with you?
No, so that's what regulators' intention has been. So they gated this excess by creating this 1 crore limit. And they want to ensure that risk management is very tight when it comes to small investors investing money in these asset classes. Through fund of fund, if you can add a layer of risk management, that fear of poor risk management goes away. And I'm sure regulator would be very happy that we are able to create access to this asset class with this additional layer of risk management for investors. And that's what regulators are concerned about. Regulators are not concerned about not giving access to specific asset classes to investors. They are more than happy to give access to each asset class, to each category of investors, provided there is high degree of risk management and thorough diligence.
Absolutely. Sandeep, do you echo?
I think similar thing, and what has happened in the past over the last decade is that a lot of people have used kind of maybe trust-based structures, LLP-based structures, and so on to be able to do this. I think the way the regulatory framework is defined now is actually very clear, very precise, and I genuinely feel that the stringent aspect will be in the interest of this industry for the times to come. Because we all know 100 successes don't get talked about as much. 2 failures, 2 issues will be blown out of proportion, and we don't want that. We are the guys who are part of the industry. You don't want 1 or 2 disturbances here and there to be able to spoil things. So for a defined period of time, at least till the time where information availability is not as transparent as it needs to be, till the time the education piece is not fully sorted out, till the time people actually begin to understand the alternate market. I think some of these things, like the minimum threshold being 1 crore, the whole structure being very, very transparent, being in a non-solicitation format to be able to not go out and do these things. I think this will work towards our interest and favor. Few years down the line, once the industry matures, I'm sure there will be alternate structures which will come out, which will be more to enable the growth of the ecosystem. So from the time and situation where we are in, I think I would personally feel that a lot of these things will work towards our favor versus any other challenge.
Sounds good. I think with that, we come to the end of a very exciting, very intelligent conversation about what's the new era of the fund of funds in the Indian private markets. But before I let the two of you go, one quick rapid fire question. Weber, for you, which is the sector and the stage of investment that people should be looking out for in private markets?
It's a tough one, but I think health tech and early stage health tech is very exciting for me.
Perfect. Sandeep, over to you. One sector, one stage.
So I think consumer side is still super, super powerful. And I think in the early side, the whole deep tech and the space tech piece is, I think, getting a lot of attention and traction. So those two remain my area of interest.
Perfect. Thank you so much, gentlemen. It was a wonderful conversation, and hopefully we'll be able to dwell into the fund of fund structures even more with the two of you. Thank you. Bye.
All right. Thanks so much. Take care. Bye.